Okay, we have most everyone signed in, so we're going to get started. Just want to say good morning. My name is Minnie Shockley. We'd like to thank you for joining our continued webcast series. Today's topic is understanding your options as tenants, landlords, and lenders in crisis. And we'll begin with our host, Josh Levering. Josh?
Thanks, Ben. Thank you. Welcome, everyone. Today is a continuation series that we've been providing at James Hanson over the past couple of months. Thank everyone for their attendance. I also want to thank our entire marketing department, as they've done a great job, and specifically Minnie Shockley, who is today's coordinator. We're pretty confident today is going to be spot on in terms of the flavor of the day and the issues that we're dealing with. As commercial real estate brokers, we are normally the first line of defense that our clients and customers go to when in times of need. As this COVID crisis has continued beyond what anybody expected, it's becoming more and more imperative that us as advisors have additional experts to join us. And it's very common today that we have attorneys, accountants, planners, lenders, all kinds of various people to join us when we give advice to our clients and customers. And therefore, we have our panel that should hopefully provide us some thought-provoking and insight information as to what we're dealing with today and going forward. Anyway, Will, could you quickly introduce our panel?
Sure.
Thanks.
Good morning, everyone. Thanks, Josh. Some brief introductions. We have Josh Levering. Let me be careful here. He's my boss. Josh has over 35 years of brokerage advisory experience here at Hanson. He's a senior vice president. He directs our Morris County office and assists with a number of other management-related activities for the firm. Josh holds the SIOR designation and has served as president of both the Tri-State chapter of IREBA and the New Jersey chapter of SIOR. Next up, we got Tony Pacchia. Tony's got 30 years of banking experience as a restructuring professional within the banking, legal, and investment communities, and is CEO and founder of Traxi. So Traxi is a special situation financial advisory group focused on providing operational, asset recovery, crisis management, and restructuring services to their clients. Next up, Michael Sieve. Mike's the president of Mountain Development Corp., one of New Jersey's preeminent commercial owners and developers. They operate a portfolio spanning 6 million plus square feet of commercial real estate throughout the Northeast. They've been recognized twice by the New Jersey chapter of NIOP as Developer of the Year. Mike himself was the former president of NIOP and now currently serves as the chairman for the William Patterson University Trustee Board. Next up, Vince Spiro. Vince is an executive vice president at PPAC Gladstone Bank. He directs their overall commercial real estate lending activities and guides the firm's commercial real estate strategic plan. He oversees a portfolio of $2 billion consisting of multifamily, retail, industrial, and office space. Next up, Hal Messer. Hal is a managing member of the CPI Funds, which is an owner and operator of triple net properties located throughout the country and valued at over $750 million. He's also senior vice president at James Hanson and past president of AREBA. So those are the intros. Josh?
Thanks, Will. Tony, let me start with you. Can you give us a general basic overview of what you think is going on today?
I can, Josh. I'm going to start us off on a pessimistic note, but we at Traxi are feeling that the current downturn prompted by this COVID-19 pandemic will be catastrophic. We see a significant wave of insolvencies coming, and it's clear that that wave will be driven by a lack of demand. So far, the Federal Reserve and the Treasury have worked hard to mitigate the damage by injecting large amounts of liquidity, but at some point that's got to end. And Powell himself has said that the liquidity measures alone are not going to bring the American economy out of this downturn. So we're thinking that the resulting restructurings will probably be the largest since the 1930s. But with the liquidity, it's tough to predict the timing and the duration. In certain sectors, I mean, I'm sure people can see it themselves, there's devastation. Restaurant owners, hotel, hospitality, they're in a bit of shock. They're not clear on next steps. They're watching experts debate how this is going to unfold. So I think they sit back, they watch the process. But at the end of the day, I think this pandemic is going to significantly change and challenge landlord-tenant relationships. We think looking ahead, planning is essential. There's going to be a scramble for talent. Portfolio management, debtor-creditor expertise will be in high demand. In good economic times, those talents are dissipated. They focus on other things. And so it's been a very long time since we've seen a downturn of this scale, which will really require workout talent at scale. While it's not here yet, we're advising clients to look ahead, make plans, gather their teams, and get ready for what's coming.
Okay. All right. Mike, any comments on that front?
So, we have a little bit more of an upbeat outlook. I think what Tony's touching on are sort of things that everybody's been experiencing. It's been a really difficult period from March to the present time for everybody, and we certainly don't diminish any of that. And like everybody else, we've had to face a bunch of challenges. However, we're encouraged by what the experience has been, at least from what we've seen so far, which is we think businesses are cooperating, businesses are finding ways to accommodate each other, businesses are finding ways to work as best they can through the self-quarantine period. And in our portfolio and in our properties, we see, or at least we expect to see, a lot of people return to the office, return to work, not full-time, but on a phased basis in September. We think the last portion of the year, you're going to see a lot of people anxious to get back at it, anxious to sort of do the things they do. And we're kind of guardedly optimistic that we're going to be looking at a recovery, and hopefully the worst of this is all behind us.
Great. So tale of two cities, huh? All right. So, hey, Hal, let me ask you. You are an overseer of, let's call it an investor operator, and you got a huge portfolio of mostly retail type tenants. What are you finding in terms of how these guys are working with you, and in general, are things good or bad?
Thanks, Josh. So, we're primarily in the triple net lease space. So our tenants are all, for the most part, national investment grade tenants that have been that fall under the essential business umbrella. So for the most part, none of our tenants have approached us looking for any concessions. We have one or two smaller operators who came for relief, and we were there to support them. We had one or two national retailers who came to us, I think, trying to be opportunistic, and we weren't so accommodating to them. As I joke with my team, we took the Goodfellas method of negotiation with them. We had to put a few in default. Those defaults were cured. And so from our standpoint, we're in the boring end of real estate, but boring works really well when times are like this. As far as where I see the market, I don't think COVID really changed anything other than being a catalyst for companies that were sort of like dead man walking. Execution just came a little quicker than maybe the market had predicted.
Yeah, thanks. Hey, Vince, let's kick it to you on the lending side. So COVID is in place, obviously going to go for an extended period of time. How do you, and if you could, maybe lenders in general, how do you generally respond to your borrowers when they come to you and they're not able to pay their loans in full?
Sure. Yeah. Good morning, all. So I guess, back in I guess mid-March, when everything started to get shut down, the banks were communicating with their clients, trying to understand, what needed to be done. The regulators did a few things to help, I would say, not only the banks, but also help small business. One is they allowed the banks to provide these deferments up until the end of the year, short term, whether they were for 90 days or 180 days, to allow the landlords basically to hopefully negotiate with their tenants to provide them with some sort of relief. The government came up with the PPP program, which injected a lot of cash capital into many of these smaller businesses that were in dire need. And many of the banks all participated in this to, help their small clients so they could stay, I would say, afloat, providing payroll, rent, and things of that nature. The problem is that, the PPP it was a short-term fix, has not completely, allowed many businesses to recover, especially in certain sectors, these non-essential businesses that have been struggling, the restaurants, the hotel, hospitality, leisure, all these sectors. Many of the banks, community banks that are local, pretty much lend on the same asset classes. A lot of commercial real estate, multifamily, retail, industrial, office. We're all challenged right now with working with our clients to understand what the collections look like, what they're doing to help their clients, and reassessing every time, reviewing information. So, as long as I would say the government allows the banks to continue to negotiate in good faith with their clients, not allowing the accounting rules to take over on troubled debt restructures, banks will be cooperative because they'll get the support from the government. If the regulators change their tune and the accountants become more harsh, banks will need to do things and be more drastic as things progress. But we're hopeful that a vaccine will be discovered very soon. And I think if there is some, provide some optimism, that will provide some, I think, relief to a lot of the consumers out there and hopefully a lot of these small businesses.
Great. Okay.
So,
Hey,
Vince,
go ahead.
Josh, can I ask a question? Vince, what's the timing on that regulatory relief? I mean, is that locked in for a while, or can you elaborate?
So the way it reads right now is if a client, a borrower was current with their loan through the end of last year, 2019, and they are impacted by COVID. They have to be able to state that they've been impacted by COVID. I don't know who hasn't been. So it's very broad. A bank is allowed to provide a short-term extension, modification, deferment, forbearance up until the end of the year, or between now and the end of the year. So that provides banks a lot of flexibility. So even on December 30th, I can provide a client with, say, a 90-day or 6-month moratorium if they want on principal interest. So that'll push things out, and we use the term, it's Novocaine. Right now, a lot of banks' portfolios are on Novocaine, and when the Novocaine wears off, we don't know where the pain's going to be, right? So, and how much Novocaine can one take as well. So we're being, supported by the regulators, and so long as that happens, I think we'll be able to get through this.
Is it fair to say that that's a suspension of the non-accrual rules?
Basically, you could be saying you're kicking a can down the road. You remember back in, in 08, 09, when the construction loans, you had interest reserves, and you utilized those interest reserves to pay the loan. It was masking a problem loan. So the question is, are deferments masking problem loans? I don't know the answer to that yet.
Interesting.
Right. Hey guys, let me maybe jump to a little different subject, and I'll go kind of to Mike and Hal as landlords. Guys, we are seeing COVID-specific language put into RFPs, proposals, leases, contracts, etc. We're what do you say? We got occupancy delays, we've got construction delays, we've got indemnification changes, guarantees, et cetera, et cetera. Are there things that I can ask you to comment on, Mike or Hal, that you're seeing and either putting into your new agreements or anticipate you'll be putting in, either from yourself or your attorneys?
Hal, you want to go first?
Sure. So the properties that we own, we buy with the tenants in place. So I have not seen anything on the tenant side because those are all older leases. However, I am willing to bet that these big national tenants, they have pretty smart attorneys and in-house legal teams, will put some language into their leases going forward. I have seen on the lender side more disclosures being asked, and also some new provisions to allow borrowers to post additional cash reserves as a cure for short-term debt coverage ratios, so to allow the loan not to go into default if tenants stop paying rent.
So I'd add to that. In terms of new leases, we are getting that request from a lot of tenants. And I happen to think, as a data point in and of itself, that's we're doing a lot of new leases right now. We are active in our portfolio with tenants who are moving into spaces. The portfolio it spans a bunch of different markets, but particularly in northern New Jersey and in Fairfield County, Connecticut, we've got a lot of leasing activity. So I think that would be welcome news for everybody. In terms of COVID language, we're seeing requests that, are forward-looking. Hey, if there's another pandemic, what are we going to do about, things like rent, and what do we do about timing for things like construction and turning space around? The latter is obviously easier to deal with, and people in the real estate industry have been dealing with construction delays since time immemorial. But going forward, we've seen different sort of compromises in different markets, but obviously landlords are not in a position to sort of fully abate rent, or they're going to end up with leases that are unfinanceable. But I think a lot of landlords are entertaining staged periods. If a pandemic lasts for a certain amount of time, then they're willing to defer a certain percentage of rent, and have it be repaid back on some sort of a schedule. That kind of language, I think you're seeing in the market. We're in different markets. I think it depends on the size of the lease and the sort of the nature of the sort of any given tenancy to the size of the building. But I also sort of think it speaks to the kinds of compromises that, businesses and multi-tenanted buildings and sort of relationship businesses are sort of forging every day anyhow.
Yeah. Okay. Got it. Hey, Vince, on the lending side, any language that's starting to pop up?
Yeah, as Hal mentioned, loans that we're closing today, will probably require some sort of enhancement in the form of maybe a debt service reserve for 6 months with a debt service P&I. We're also, I would say, being a little more cautious on LTVs, so there's a little more skin in the game. Cautious, maybe refinancing, pulling cash out for other investments. And we're also, basically talking about actually personal guarantees or limited guarantees. Many of the loans that we do are non-recourse, with the exception of the bad boy clauses. However, we've actually had some borrowers come to us and say, listen, I'll provide you a guarantee for 18 months and a 6-month reserve. Can you do this deal for me? So, and we're doing that. But the leverage is a lot lower, and the covenants, are maybe a little tighter. It's challenging right now to get comfortable with anything coming in new, because you just don't know what's happened to the rest of your portfolio out there, whether it's going to come off deferment. So kind of challenging to underwrite a new deal and book a new deal in this environment.
Jesus. Hey, let me continue, Vince. So you basically process loans and handle your customers and clients by committee generally. With the difficulty of getting together, it's become pretty commonplace that we don't know how quick it's going to take you to process loans, existing or future clients, customers. Any suggestions or recommendations for our audience in terms of what they might think about in preparing to approach a PPAC, when they're going for debt?
Sure. One, I would say, expect more time to underwrite and process third-party, appraisals, environmental firms, inspections of properties are taking a little bit longer. I would also say that, right now, historical information probably isn't as important as, even a forecast. So obviously, we do a lot of multi-tenanted properties. And the ability to project the cash flows on these are very important, because historical, really doesn't mean anything today. What are collections look like? Also maybe, talk about, bubble tenants. If it's a shopping center, be able to speak about what's going on with certain tenants, their payment histories, and their future viability. So if you take a retail shopping center, for instance, where you can have grocery, pharmacy anchored, what are the satellites? What's the probability? And the idea there, I think, if there's some uncertainty about the viability of certain tenants, expect the bank to either discount those cash flows, require more equity into a deal, or again, as we talked about before, posting reserves.
Vince, I'd like to ask another question going off of that. I've heard that new loans and new customers of banks, it's very there's not a lot happening, and there's been much more of a focus on relationship banking. Is that the case, and how do these discussions unfold?
Yeah, I think the biggest challenge right now is to bring in a new client where you have no experience with them. What we're trying to do is take care of core clients, help those that require any assistance, whether it's forbearance or acquisition of property or refinance. We do have access to their usually global information, which is very important, understanding global cash flows. And to bring on a new client now and not knowing what their world looks like today is probably the biggest challenge. So I think most banks, including PPAC, trying to stay focused with their core clients, the ones that have been with them. And the idea is you have to be with them as well. You have to be able to provide those accommodations with those clients so that they become better and stronger and develop. We've had some success through PPP. We were able to provide, I would say, more business owners with relief or process their PPP, and then provide them opportunities as well to change banks. The big banks were struggling, just like every bank was struggling to process PPP. And typically, a lot of banks, lost some clients along the way, which is unfortunate, but, good for the community banking system, really.
Can I add something to that? From like the borrower side, which I think is the other side of the coin, which is, the question made it seem like, hey, there's nowhere to go to. The only people who are sort of getting the benefit of loans are people that already have established relationships. But I would have said the reverse, which is this Northern New Jersey, Northeast market is full of banks and borrowers that enjoy, I think, really good long-standing relationships. And I think the experience over the past couple months is those relationships are real. It's not just lip service. The banks and the borrowers, they know each other. They're familiar with each other's operations. They know how to move quickly through these kinds of matters and accommodate each other. We closed 2 new loans on 2 acquisitions, in April and May with banks that probably Vince would consider, colleagues of theirs or competitors of theirs, M&T and Lakeland Bank. And those loans closed without sort of, any of the sort of difficulties that you would sort of worry about. I think it speaks to the resilience of the banking industry, that the banks are well capitalized. I think it speaks to a tradition of borrowers and banks really understanding each other's businesses. So when it's time to conduct business, they're up to speed. And I think it's what's going on in this market. People are finding ways to press forward and get things done and do what has to be done to close transactions. That's a tremendous thing. I think it's something people should be proud of, and I think it's a good indicator that the market is getting through this.
Yeah, I would also add, I think this is very similar to what we saw in, call it 08 to 2010, where we do a lot of business with medium and medium-sized regional banks and community banks. And they were jumping at the opportunity to do our type of deals, which they never really had the opportunity to do because they couldn't compete with Wall Street. And so when, a little bank in California could finance a Walgreens, they weren't used to making loans on an investment grade deal. And the small banks had money. They had TARP money, and they didn't have any of the problems that the big banks had with the subprime loans. And I think you're seeing the same thing happening today.
Okay. Hey guys, let me throw out to the panel. How are you in your respective businesses preparing now for what's going to be an extended period of time, of let's call it the crisis that we're currently in. I mean, any words for the wise?
Sure. Well, let me start with what we're advising people. And, every situation is different, so generalizing is tough. But to clients across the board, we're advising them to, keep an eye on what we call the 3 C's. Focus on cash conservation right now. We're working through rolling cash flows, updating, stressing them, critical. It's the essential when we get involved in a situation. Communicate. Everybody in the process needs to communicate well. The tenants, landlords, bankers, whatever's put out flows through that cycle. So building good communication is essential. And then all of this is designed to help people control their destiny. We tell clients, any decision you make is better than a decision that somebody else is going to make for you. So try to control your destiny. And, as landlords look out at the spectrum of tenants, there's going to be winners in the portfolio. People are going to do well through this crisis. That's great. Support them, ride with them. There's going to be losers. As soon as you can identify those zombies, my suggestion would be run, right? And then there's going to be a whole lot of work in between, because most people are not going to present as clear winners and clear losers. So gather information, make your plans, trade, accommodate, adjust, and get ready for, I think, a grueling ride.
Anyone else?
So what we're doing is, to echo Tony, in terms of cash, we have elected on the 3 funds that we manage. We reached out to all of our investors. We said, we have great news. I think across the 3 funds in the second quarter, we collected over 97% of our rent. That said, we lowered our distributions slightly by about 20% to reserve cash. It's great that our tenants were able to survive the first lockdown, but we don't know what the future looks like. And so we want to be prepared so that we can meet our debt obligations. That's the most critical thing we have. If we don't have good relationships with our lenders, we're out of business. And then we're looking for opportunities. Like I said, right now boring works, and that's where we are. We like to buy deals from developers. Developers in times like this have problems. They have loans that are maturing, and they need to sell the good assets to take care of the bad ones. And so where we can jump on those opportunities, we need to have enough dry powder to do so.
Interesting. Hey, Tony, and I'll ask everybody else, but Tony, this is probably, a good one for you. When you have your clients or customers, call it your tenants, et cetera, coming to you and asking, for help. Personally, and I know everybody in my office, we have a dickens of a time working through, the PPP paperwork, what government assistance loans are available, what federal loans are available, what local things are available, et cetera. Do you work, I presume that's what you do, Tony. And I also, would assume that maybe, Vince and Mike and Hal, do you guys provide assistance to, help with that kind of bobbing and weaving that people are so desirous of today?
Sure. As we plan, and a lot of what we're doing right now is survival and revitalization and planning for the future. Certainly, those are all tools. What gets you through the crisis is essential, and we are certainly advising people on what's available and how to work through it. In general, my experience with the banks has been good on PPP. They've been receptive. They've been overwhelmed. There's been some delays, but our clients have successfully negotiated through to money.
Okay. All right. All right, let me ask, how about Mike and Hal? Guys, as you have tenants approach you asking for relief or help or advisement, what is it that you typically are asking of them that you think that they should be comfortable in providing you? And secondly, how invasive do you think you're able to go when you look into delving into somebody's business?
Do you want to take that, Mike?
I'll take it. From our standpoint, I think we consider ourselves to be probably a little bit like, Vince and the banks consider themselves to be like a relationship landlord. We know our tenants, we understand their businesses generally, we have a relationship with them pre-COVID. So, we're not fielding inquiries and sort of having to get to know them from scratch. We've been probably in touch with every tenant in our portfolio, and by and large, most of the tenants have been able to sort of pay rent and conduct business on a remote basis during this pandemic without sort of assistance from us. And interestingly, some of our tenants, particularly one of our law firms, reached out and actually offered the reverse, which is whether they could assist anyone else on a pro bono basis with filing PPP claims, which I thought was an outstanding gesture. That was Lowenstein Sandler. But where people have needed help, we've entertained it. We deal kind of principal to principal on those things. Obviously, we expect transparency, and I just think the more people are able to explain their situation, the better. And we did try to draw the distinction between akin a little bit to what Hal was suggesting, tenants that said, hey, we don't want to pay rent because we're just uncertain about the future and we want to hoard cash. We were not that sympathetic to, because, hey, like everybody has that impulse, but the system shuts down if nobody pays their bills and just hoards cash. But tenants that were obviously disrupted, if we could help them, we did help them. We don't have all the tools at our disposal that a bank would have, but we certainly have a lot of things that we can do that are creative to help tenants and play around with timing. We did some lease extensions and gave free rent up front and things like that. And, I think that's what makes for a good landlord-tenant relationship. It gets tested in times like these, but at least in our case, these are long relationships and we're in a short period of time. And, we think we're going to look back on this time in a few months, hopefully not too many, and we're going to be pleased that we got through it with our reputation intact, and we're going to be pleased that the people who called us for help, got the kind of responses they wanted.
You bet. All right. Let's see. Let me continue with that, Mike.
Can I ask a question?
Sure.
So Mike, I was interested when you said that you're seeing leasing activity. Could you expound on who's coming to you and what's the nature of, the interest?
We're probably doing 6 different leases right now, 1 in Fairfield County, 5 in New Jersey, all leases under 10,000 square feet, which are new offices, tenants that say, hey, we want to reopen. We don't want to be in New York right now. We're not giving up our New York office, but we want something that's close to where we've got a lot of our employees. We need them to be together, but we don't want them, commuting for a really long period of time. And some are short-term, some are long-term. They're with tenants that we're delighted to add to the portfolio. And I think it speaks to companies that are saying, hey, we're going to spend some money. We need to restart our activity. Working from home is great, but it's no way to really run our business. We need people doing stuff. We need to be hiring people. We need to be making decisions and collaborating. So we take it as a great sign. And we don't necessarily expect that all those tenants are going to become long-term tenants in the portfolio, but we think some of them may well. And we think it speaks to some of the desirability of some of these great New Jersey communities that are just full of, it's where people who have choices live. They have great school systems. They have the downtowns that people have affection for. So owning office space near those communities feels like it could be a good spot for the near term.
Great.
Yeah, Mike, has the vetting process for tenants gotten a lot more in depth since the pandemic has started? Like, how are you assessing that?
I like to think, of course, people can form their own opinions. I like to think we had a good vetting process before, and the vetting process was a little bit akin to what I was talking to, which is we meet people directly and we talk to them, and we know people, every business is different. Every business in different cycles faces different challenges, and we certainly don't pretend that we can anticipate that stuff. But we know people who are straight shooters, and we know people that are creative and smart and work hard, and those are the kind of people we want in our portfolio. And generally speaking, I think those are the people who are getting through this thing pretty well.
It's interesting. We have a number of landlords, and so for example, we have one guy that quickly sends out default notices to, I think, put people on notice. Another landlord, he basically wants to sit with a face-to-face meeting with whoever wants to approach him before he'll even begin any discussions. And then we also received a crazy questionnaire from one of our landlords asking for pretty invasive information. Anyway, 3 different approaches that, were different.
So I would say, to the middle landlord who wants to sit with people and, a little bit talking about the different banks. Relationships matter. You may think you're saving a basis point, when things are awesome and you pick somebody else, or you may think you get an extra 50 cents in rent. But at the end of the day, if you're paired with the right people and you treat each other well, this kind of period goes a lot better.
I'll give you an example of a deal we just closed or about to close. It's a suburban office, which is typically an asset banks have been trying to stay away from for a period of time. I think there's going to be a revival of suburban office. But the client that came to us back, I want to say probably in May, and was under acquisition for a property. We had talked to him about terms and conditions. And I went back to him and I said, I can no longer honor those terms and conditions. This is pre-COVID terms and conditions. And he's like, you know what? I don't care. I want to buy this building. I value the relationship I have with you. If I have to pay a few extra basis points is more, whatever, tell me, if it takes me another month to close it, I want to do it. He was doing a 1031. So we had a little bit of time, but not a lot. But it came back to, it was like, as Michael said, it's relationships. He felt confident that we can get it done for him. I told him this, what I would be able to get done for him. And he was able to, when I say it's close to closing right now, but successfully acquire a building in this time. And the occupancy pre-COVID was 100%, and we believe the occupancy now is still 100%. So it goes back to what Michael was saying. People still are going into the offices, especially things that are probably close to home and less commute. So I think short-term suburban office is going to have expect a good period of time there in the next 3 to 5 years.
Okay. Hey, Tony, let me ask you. You're an advisor to all, right? How do you suggest, that you engage with customers and clients in receiving the information that you need to be able to advise them? Right? What do you do? They come to you at the front end, but you've got a lot of things that you've got to deal with. What do you do?
Well, the people coming to us right now have very specific focus, right? And I can tell you that we're long on food service and hospitality. And honestly, I don't have great answers for them, right? We're all watching the same news coming out of the same scientists. There's real devastation in those sectors right now. We could ask the whole panel, when's anybody really going to go and gather in a restaurant the way we used to? When's anybody going to go to a Broadway show or a Yankee game? These things are out in the future at some point. And how do you build projections if you don't know where in the future? So our focus with a lot of those clients, Josh, right now is just survival. How do we keep them in the game? And that means being open to talking, different strategies. I've been surprised. I've seen the activity at sort of the top of the spectrum, right? You've got Simon Properties out there, one of the biggest landlords in the world, taking equity interest in their tenants to keep those boxes full. That's fascinating, right? They're going to buy Lucky Brands and run a fashion house. They're going to buy Aeropostale, and I think there's talk about them going after Brooks Brothers. That's kind of amazing to me. And if this thing continues, I think other landlords are going to be facing similar challenges with tenants that they want to prop up.
Wow. Very interesting. That's a different approach for sure. All right. Hey, Vince, the government has provided incredible amounts of liquidity into our system, right? what is your take on whether or not you think this is going to continue? So obviously this has allowed you to, play nicely in the sandbox with your borrowers. Right? So my really question is, how long do you think it's going to continue? Do you think it's going to continue? And probably more notably, what happens when and if it dries up?
Yeah, so great questions there. I do believe the government will continue to provide funds to these small businesses so that it can stay afloat. For how long, we don't know, right? There's talk about, I got to say, PPP phase 3 with some different terms and conditions, maybe allocated to either minority groups or certain business types that, have struggled, or 50% in revenues. Things of that nature. They're even talking about maybe extending the term out of these loans where they really become capital. They're not even loans anymore. Originally it was a 2-year loan, went to 5 years, and now they're talking 20 years. Banks aren't going to make a lot of money doing 1% loans at 20 years. I don't know if the government provides these programs, whether the banks will actually want to support with them. The Main Street program is another program that came out, really has not taken off well. We've had some conversations with some of the hotel operators. The program is not designed for the hotel operators, really. It's designed for Main Street, smaller businesses. So I think they're going to keep trying. The only thing they can do is, listen, this is a health crisis that is turning into a financial crisis. And the government needs to find a way to keep it from becoming a financial crisis. All these banks are much more capitalized than they were in the Great Recession, so we'll get through this. But what we need to continue is we need to have funds flowing. We can't get a credit freeze, because if we have a credit freeze, that's going to change everything. That's a game changer right there. That stops the flow of funds. So I think the government has to find ways to keep the banks flowing money out and allow them to make loans so that businesses can grow, acquisitions can happen, refinances can happen. But I think it's just going to be, they're going to continue to assess the economy every month to determine what they need to do.
Thanks, man. Okay, so I know we're kind of running out of time. We'll try to bring this thing to an end. Coattailing what you just said, Vince, let's Michael and Hal, you're investor developers, etc. You're likely preparing for some bad times. Most notably, are you anticipating distressed assets, and when that occurs, are you going to be buyers?
So yes and no. Yes, I anticipate a lot of distressed assets. I think, obviously, as we mentioned, hotels and entertainment, I don't see how they survive without serious support. Dense urban centers, I think, are in a lot of trouble. I think that was also sort of happening a little bit before COVID with rising crime and so forth, high taxes. So a lot of businesses moving to Florida, Texas, tax-free states, which is something we were always bullish on, the tax-free states, because if you have a wealthy investor doing a 1031 who lives in Palm Beach, the last thing he wants to do is buy a property in California and pay like 13% tax. So I think those trends are continuing. I think retail, big box retail has some problems that pre-existed COVID with Amazon and online shopping. So yeah, I think there's going to be a lot of pain out there. But where there's pain, there's opportunities. People like Mike who are smart are going to figure out how to buy a distressed office building and one way or another reposition it, get it leased out, and do very well. That's not really our business, but I think there are going to be a lot of opportunities out there for people to make a lot of money.
You agree with that, Mike?
Yeah, I think, there's sort of distressed opportunities seemingly in every market. For one reason or another, buildings can lose tenants or lose their footing, and they become opportunities for somebody else. And a lot of times we like to do that. But we are, we're still trying to press forward with the kinds of, not just those opportunities, but just regular opportunities that make sense. We built a couple of years ago a really nice Class A office building in West Windsor, in the Princeton market, and we may break ground on a second spec building now. I think part of what part of what restarts the economy that benefits all of us is consumer confidence. It's people who are business leaders spending, hiring, investing, making the decisions that lead to activity and jobs and everything else. And, we want to do our own little part to try to be on the point of the spear and press that forward. We're endlessly confident in the talent that resides in our markets, that Northern New Jersey, that Connecticut, that New York are full of smart, talented, hardworking, creative people. If we fill our buildings with those kinds of people, they will find ways to be successful. They'll find ways to occupy the space, to pay rent, to make money, to be happy, to make our economy the kind of robust, diversified place that it has been so far. So, pandemic aside, nothing about the pandemic diminishes our confidence in the kind of people that live and reside in the communities in which we're investing.
Well, here. So I think that's a fabulous high note to end on today. Are there any last questions that anybody might have? Kind of quickly.
Yeah, I'd ask one more. As a newer person in commercial real estate, I'm pretty fortunate to find myself in a webinar with you guys and speaking with some veterans. How do you guys foresee the next few 6-12 months unfolding? What are your predictions?
So I was just going to say, as starting your career as a real estate broker now it's probably the best time you can ever do it, because your clients are going to need your advice more in a challenging market than they ever would of your firm, and give the people who rely on you for real estate advice outstanding guidance when it's not just the middle of the fairway and doing the easy stuff. And you can make friends now that can be business friends for life if you do it right. So, have at it.
Yeah, I would echo that. As someone who was in your shoes almost exactly 20 years ago, I started out right when the dot-com bubble burst. I was living at home, which was, I guess, a good and a bad thing. The good thing was I had no rent. I didn't need to make any money. I just had to, fill my car with gas and buy some beers for the weekend. And so you're going to learn an awful lot. Surround yourself with good people. Listen and work really hard. And when this comes out, you're gonna have it. I would say a much better degree than anyone who goes for an MBA right now.
Great.
Yeah, I would agree. I would agree. You're going to get your PhD in real estate real quick.
Okay, guys. Listen, I want to thank all of you for your participation today. Hopefully, we had a good audience. Everybody learned a lot of information. You guys are all top of your field, and it's really, really appreciated. And frankly, I found out a lot of new information today. On behalf of myself, Will, James Hanson, appreciate your participation. And I guess if there's anybody out there that wants to see this, we've recorded it. If anybody has any specific questions to our panelists, if you forward it to Will or myself, we'll forward it and get you those answers. And or if you want to speak to our panelists directly, we'd be happy to forward you their contact information. So again, thanks everyone. And
Thank you, Josh.
Speak soon.
Thank you, Josh. Thanks,
Bye,
Ross.
guys.
Bye-bye.
Bye-bye.